So if a company buys back $500 million of its own stock in a single quarter,
right,
but then they turn around and flat out refuse to raise their profit forecast for the rest of the year, I mean, what exactly are they not telling you?
Yeah, it's the ultimate corporate paradox, honestly. You're basically standing on the table, shouting to the market that your equity is massively undervalued.
Exactly.
But simultaneously, you're whispering to Wall Street analysts that the next 6 months might be incredibly turbulent.
Welcome to this deep dive, everyone. Today, we are cutting straight through the really dense, jargon-filled first quarter 2026 earnings call of Xylem Inc.
Ticker symbol XYL.
That's right. And for those of you joining our Talk Tickers format, our mission today is really simple. We're going data forward. We are translating all that corporate speak into plain English. And we're going to figure out if this water infrastructure giant is actually a buy, a hold, or a sell for the retail investor.
And we're looking at a company that operates in a sector that is quite literally a prerequisite for human survival. I mean, Xylem provides mission-critical water technology.
Yeah, the invisible stuff.
Exactly. They build the massive municipal wastewater treatment pumps, the smart water meters attached to your home, and, the ultra-pure process water systems for industrial chemical plants.
But as their latest earnings report shows, even a business model built around humanity's most essential resource, well, it has to navigate some violently choppy macroeconomic waters right now.
Oh, absolutely.
We're looking at this landscape of, volatile inflation, shifting global supply chains, intense geopolitical tensions. So the question we need to answer for you today is whether Xylem's growth is actually structurally sound
or if there are hidden leaks in the foundation, right?
Leaks that retail investors are just completely missing.
So to find those leaks, or to prove the structural integrity, I think we have to start by tearing down the raw data they just reported for Q1. Let's look at the baseline performance before we get into the wild narratives driving it all.
Good call. So right out of the gate, Xylem delivered an earnings per share EPS of $1.12 for Q1.
Which is a very solid beat against expectations, by the way.
It is. It represents a 9% increase over the same period last year. But, a 9% bump in EPS only tells a tiny fraction of the story.
Right, because of inflation.
Exactly. When I look at an infrastructure company operating in a highly inflationary environment, the top line is interesting, sure, but the bottom line is where the actual war is won or lost.
You're looking at the EBITDA margin.
Yes. Earnings before interest, taxes, depreciation, and amortization. It's the rawest measure of a company's operational engine, before the accountants start applying tax rules or calculating factory wear and tear.
And Xylem's adjusted EBITDA margin for the quarter reached 20.6%.
Which is a 20 basis point increase year over year.
Right. And I know it sounds like a tiny incremental bump, just 0.2%.
Yeah.
But in the context of the current industrial economy,
it's huge.
It really is. Maintaining, let alone expanding, that margin right now is a tremendous feat of operational leverage.
Let me formulate a hypothesis here, because looking at the broader market, Xylem has been facing the exact same headwinds as every other industrial manufacturer over the last year.
Oh, yeah. Raw material costs are up. Fuel prices are swinging wildly.
Right. And management even admitted on this very call that they experienced lower sales volume in certain segments and an unfavorable product mix.
Yeah, they did.
Usually, if your input costs spike and you're selling a higher proportion of your lower margin products, your overall profitability should just get absolutely crushed.
Logically, yes.
So the fact that their margin expanded suggests to me that they possess an almost ruthless degree of pricing power. I mean, am I reading that correctly?
Your hypothesis hits the nail on the head.
Yeah.
That 20.6% margin is the mathematical proof of their pricing power.
They didn't just eat the inflation.
Exactly. They didn't passively absorb those rising raw material and labor costs. They successfully passed them straight through to their customers.
Wow.
And more importantly, they coupled those price hikes with aggressive internal productivity gains. So they found ways to operate their existing factories more efficiently.
So charge more, spend less.
Right. Between charging more for the product and spending less to assemble it, they entirely neutralized the dual threats of inflation and lower volume.
That is the hallmark of a resilient business. But a high margin only matters if you actually have customers lining up to buy the product. Which brings me to the demand metrics, specifically their backlog and their book-to-bill ratio.
Oh, the backlog.
Yeah. Xylem reported that their ending backlog, so the total value of contracts they've signed but haven't fulfilled yet, increased sequentially to a staggering $4.7 billion.
It is a mountain of deferred revenue. Just $4.7 billion of future cash flow sitting on the books, waiting for the engineering and manufacturing teams to catch up.
And to understand the mechanics of how a backlog that massive actually functions, we really need to look at the book-to-bill ratio. For the entire enterprise in Q1, their book-to-bill was above 1.0.
Right.
Now, I like to compare this metric of being above 1 to a restaurant.
Okay, let's hear it.
So if your book-to-bill is over 1, it basically means more people are getting in line to order than the kitchen is currently serving out the door.
That's a great way to put it.
Right. It guarantees you've got future revenue waiting to be cooked. Even if no one new walks into the restaurant for an hour, the kitchen is still going to be slammed.
It's a fantastic visualization of industrial visibility. Having a book-to-bill over 1.0 gives management, and by extension, the shareholders, a tremendous buffer against short-term macroeconomic shocks.
But wait, we have to introduce a vital nuance here, don't we?
Yes, we do. Because while the book-to-bill was strong, the actual rate of new people getting in line, the total orders for the first quarter, was flat compared to last year.
0% growth in overall orders.
Right. 0%.
That is the exact kind of metric that trips up a lot of investors. I mean, how can you have 0% growth in new orders, yet the line out the door is still growing and the book-to-bill is above 1?
It really comes down to the sheer lumpy scale of the infrastructure projects they take on.
Lumpy. I like that.
Well, it is. When you're building municipal wastewater facilities or industrial cooling systems, you aren't selling widgets on a daily subscription.
Right.
You're signing massive multi-year contracts that hit the books all at once. In their Water Solutions and Services segment, what they call WSS orders, were actually down slightly for the quarter purely because of the timing of these giant capital projects.
Got it. So they had a huge influx of orders in the prior year that just didn't repeat in this specific 3-month window.
Exactly. So the flat overall order number is essentially an optical illusion masking the underlying churn of the business.
That makes a lot of sense.
The underlying demand across their other segments, particularly in measurement and control systems, was robust enough to keep the overall book-to-bill positive. They are churning through an incredible volume of existing work while still securing enough new contracts to keep the pipeline fundamentally expanding.
We are definitely going to dive into the bizarre, almost violent swings happening beneath that flat order number, because there are some generational trends buried in there.
Oh, definitely.
But before we leave the raw financial data, we have to talk about how management is treating their own stock.
The buybacks.
Yeah, because their capital allocation strategy right now is aggressively loud. In February, Xylem authorized a brand new $1.5 billion share repurchase program.
And they wasted absolutely no time executing it. In the first quarter alone, they bought back $581 million of their own stock.
Over $500 million in just 90 days.
It's a blistering pace for a share buyback.
Add to that the fact that in January, they increased their dividend by about 8%. I mean, when a management team is simultaneously hiking the dividend and backing up the truck to buy their own equity, they are sending a definitive signal about their confidence in their future free cash flow.
They're putting their balance sheet where their mouth is, essentially. They generated positive free cash flow in the first quarter, and management reiterated their long-term framework to achieve a low double-digit free cash flow margin.
Right.
But as retail investors, we have to look at how they funded that $500 million shopping spree. You don't just find $581 million in the couch cushions.
No, you don't. So what did it do to their debt profile?
Because they spent so heavily on buybacks, their net debt to adjusted EBITDA ratio actually increased by 0.6 times.
Meaning they deliberately took on a bit more leverage to fund the repurchases.
That is the mechanical reality. They're currently managing their leverage between half a turn and a full turn of net debt to EBITDA.
Which is pretty standard, right?
Yeah, in the industrial sector, that is still an incredibly healthy, conservative level of debt. But it illustrates the strategic choice. They looked at their stock price, looked at the broader market volatility, and clearly perceived a massive dislocation.
They think the market is wrong.
Exactly. They firmly believe the market is undervaluing their long-term cash generation capabilities, so they're willing to pull capital off the balance sheet and leverage up slightly to buy the dip.
Okay, so let's consolidate the baseline before we look under the hood. We got a solid EPS beat. We have margins expanding in the face of inflation because they have the pricing power to force the costs onto the customer.
Yeah.
We have a massive $7 billion line of backlogged revenue. And we have a management team that is so confident they're taking on slight leverage just to buy back their own stock at an aggressive pace.
On paper, it looks like a titanium-clad quarter.
Right, on paper.
But as we hinted at with that flat order growth metric, the surface-level tranquility is hiding an absolute tug-of-war beneath the surface.
Let's talk about that tug-of-war.
Well, if you look at the individual business segments, Xylem is currently experiencing unprecedented generational growth in certain areas while intentionally blowing up other parts of their own business.
Which is the perfect pivot to Section 2, the actual story driving these numbers. Let's start with the unprecedented growth because the sheer scale of the projects they're winning is just staggering.
It really is.
You mentioned earlier that their Water Solutions and Services segment, WSS, saw a slight decline in Q1 due to project timing.
Right.
But the context for that decline was totally shattered right after the quarter closed because in April, they booked something that changes the entire trajectory of the segment.
They booked the mega contract.
Yes.
It was the largest single order in the history of the WSS division. An $850 million outsourced process water contract.
Nearly $1 billion from a single client.
Yeah. Now, they cited confidentiality agreements on the call, so they couldn't name the specific customer, but they did reveal it's an existing client in the specialty chemical manufacturing vertical.
Okay, so specialty chemicals.
Right. Xylem is going to be providing them with ultra-pure process water for cooling and boiler feed water for their manufacturing operations.
I want to pause here and really dig into the mechanics of this.
Sure.
Because understanding why a chemical plant would sign an $850 million contract just for water is crucial to understanding Xylem's whole value proposition.
It's a great point because to the average person, water is just the stuff that comes out of the tap, right?
Exactly.
But in industrial chemical manufacturing, water is a highly engineered, deeply complex component.
Right. We aren't talking about drinking water. When a specialty chemical plant runs massive boilers or requires precise thermal cooling, the water they use has to be stripped of almost all natural minerals, salts, and impurities.
Because if it isn't...
If you run standard municipal water through an industrial boiler operating at extreme temperatures and pressures, the calcium and magnesium in the water will instantly cause scaling.
Oh, yeah.
It builds up a hard crust inside the pipes, destroying the thermal efficiency of the boiler and eventually leading to catastrophic explosive failure.
Not what you want in a chemical plant.
Yeah.
Furthermore, any microscopic impurities in process cooling water can cause rampant corrosion in the metallic infrastructure or, completely contaminate the delicate chemical reactions happening in the plant.
Right.
So purifying and managing that water requires highly sophisticated filtration, reverse osmosis membranes, chemical dosing, and continuous real-time monitoring.
It is incredibly capital intensive and technically complex, which I guess explains the customer's motivation here. A specialty chemical company wants to focus its capital and its engineering talent on inventing and manufacturing new chemicals.
Exactly.
Not on running a world-class water purification plant in its own backyard. So they outsource the entire headache to the experts at Xylem.
But the structure of how this $850 million is paid out is the real holy grail for retail investors.
Tell me about it.
The chief financial officer, Bill Grogan, laid out the economics pretty clearly. The total value is split into two distinct phases. 25% of that $850 million is dedicated to the upfront capital build.
So the hardware.
Right. The physical construction of the purification infrastructure, the pumps, the sensors, the pipes. They expect to realize about 10% of that contract value this year, with the remainder of the build-out revenue flowing in next year.
So that's the traditional cyclical manufacturing revenue. You build a thing, you get paid for it.
Correct. But the remaining 75% of the contract is what transforms the business model. Starting in 2028, once the physical plant is actually operational and the ultra-pure water starts flowing, Xylem locks in a 20-year service tail.
Wait, 20 years of guaranteed recurring service revenue?
Exactly. Xylem isn't just selling them the hardware and walking away. They are operating the infrastructure, maintaining it, monitoring the analytics, and guaranteeing the water quality for 2 decades.
Wow. This represents a massive strategic pivot. They are actively transforming themselves from a heavy industrial equipment manufacturer that has to, constantly hunt for the next one-off sale into something that structurally resembles an enterprise software company.
Water as a service.
Yes, water as a service. You get the high-margin, sticky, recurring revenue that investors usually associate with a tech stock, but it's backed by physical, deeply entrenched industrial infrastructure.
And this specific chemical plant contract proves that their strategy is resonating at the highest possible enterprise scale. Customers are willing to lock themselves into a 20-year marriage with Xylem because the cost of failure is just too high to trust anyone else.
Okay, so they have secured the holy grail of industrial process water. But then you look over at their applied water segment and you find a narrative that is arguably even more explosive.
The data center boom.
The data center boom.
This is where macroeconomic trends and physical engineering collide in a really fascinating way. And Xylem is positioned squarely at the intersection.
We cannot go 5 minutes in the financial media without hearing about the artificial intelligence supercycle, right?
Oh, it's everywhere.
Companies are spending hundreds of billions of dollars hoarding highly specialized GPUs, graphics processing units, to train massive large language models. But what people often ignore is the physical reality of what those chips do when they operate at maximum capacity.
They generate heat.
A terrifying amount of thermal energy.
And the physical constraints of the digital boom are quickly becoming the primary bottleneck for the entire technology sector.
Exactly. You cannot simply point a desk fan or a standard HVAC air conditioning unit at a server farm processing trillions of calculations per second. Air is a terrible conductor of heat.
It really is.
As these AI chips get more powerful, they cross a thermal density threshold where traditional air cooling physically cannot remove the heat fast enough. The chips will literally melt themselves down.
So they need liquid cooling.
Yes. The laws of thermodynamics dictate that you must transition to liquid cooling. Water is vastly superior at absorbing and transporting thermal energy.
And this is where Xylem's infrastructure becomes non-negotiable. Building an AI data center now requires highly advanced, mission-critical, closed-loop water cooling systems.
Right.
The pumps have to be flawlessly reliable. The water has to be perfectly managed to prevent any risk of leakage onto, billion-dollar server racks. And the thermal exchange has to be perfectly calibrated.
So how is that translating to Xylem's bottom line? Because everyone claims to be an AI play these days.
Well, on the earnings call, management dropped a statistic that should make any investor sit up and take notice.
Okay.
In the first quarter of 2026, Xylem's data center orders exceeded their total data center orders for the entirety of 2025.
Wait, really? Let me just make sure that sinks in for you listening.
Yeah.
In 3 months, 90 days, they booked more business for data center cooling infrastructure than they did in the previous 12 months combined.
Yep.
That goes way beyond rapid growth. That is a vertical takeoff.
It perfectly illustrates their role as the premier pick-and-shovel provider in the AI gold rush. Xylem doesn't need to invent the next big language model.
Right.
And they don't need to design the next microchip. They just need to provide the thermal management infrastructure that makes the entire AI ecosystem physically possible.
And from a portfolio perspective, these data center projects will eventually flow through as incredibly high margin revenue for their applied water segment. This is crucial because it helps counterbalance some of the cyclical softness they're experiencing in their residential end markets.
Oh, absolutely. The growth narrative is undeniable. Between the 20-year specialty chemical contract and the vertical explosion in data center demand, the top-line potential is massive.
Yeah.
But this brings us back to that tug-of-war we discussed earlier. Because while these segments are booming, there is a massive anchor dragging on their overall growth metrics. We need to look at China.
Right. So while the U.S. utility market was up double digits, largely driven by massive domestic infrastructure needs, Xylem's revenue in China was down 30% year over year. Down 30%.
A 30% drop in a major market like China sounds terrifying. During the Q&A portion of the call, an analyst rightfully asked them if they had hit the floor in that market.
And what did they say?
Bill Grogan, the CFO, stated they are, quote, bouncing at the bottom. But he broke that 30% decline into 3 distinct buckets, which I found highly illuminating.
Yeah, he attributed roughly 1/3 of the decline to general macroeconomic softness in the Chinese real estate and industrial markets.
Okay, makes sense.
Another third was attributed to aggressive pricing and market share capture by local domestic Chinese competitors.
The competition is fierce.
And the final third was attributed to Xylem's own intentional walkaways.
Okay, and this is where my radar goes up. Because as an investor, when I hear a management team claim that a massive drop in revenue was partly intentional, I get very skeptical.
My immediate hypothesis is that they are hemorrhaging market share to cheaper local competitors, and they're using the phrase intentional pruning as a convenient corporate excuse to cover up a major strategic failure in the region. I mean, at what point does intentional pruning just become an excuse? Am I being entirely too cynical here?
Well, your cynicism is a required survival trait in the stock market, honestly. It is a risk that investors absolutely must monitor.
Right.
However, to evaluate their claim fairly, we have to look at how this behavior aligns with their broader global strategy. This intentional pruning isn't an isolated incident happening only in China.
Where else is that happening?
They are executing the exact same strategy in Western Europe, specifically within their water treatment business. Management refers to this under the umbrella of their 80-20 efforts.
Okay, let's unpack this 80-20 strategy for the listener, because it is a foundational concept in industrial management, but it's often misunderstood as just generic cost cutting.
It's way more than that. The 80-20 rule, formerly known as the Pareto principle, is an economic observation that roughly 80% of outcomes come from 20% of causes.
So in a corporate context?
In a corporate context, it usually means that 80% of your profits are generated by just 20% of your top-tier customers or your most highly engineered products.
Which implies a really dark flip side for the rest of the business.
Exactly. It implies that you are spending a massive, disproportionate amount of your time, your engineering talent, your supply chain logistics, and your sales energy servicing the remaining 80% of your customers, who are only contributing 20% of your profit.
Wow.
Often, these are highly complex, low-margin, heavily commoditized projects where you have zero pricing power and are fighting tooth and nail just to break even.
It's the classic trap of chasing revenue at the expense of profitability.
Precisely.
You take on a terrible project just to keep the factory busy, but the administrative overhead and the razor-thin margins actually destroy value.
And Xylem has spent the last year undergoing a multi-year operating model transformation to fix this. The core tenet of that transformation is simplification. They are actively implementing the 80-20 rule by taking a hard look at their portfolio and having the discipline to walk away from bad business.
Even if it hurts top-line revenue.
Even if it hurts. If a project in China or a water treatment contract in Western Europe doesn't meet a strict profitability threshold, or if it requires too much custom engineering for too little return, they simply refuse to bid on it.
So they really are deliberately killing off their own low-margin revenue streams.
They are. And it takes tremendous discipline because, in the short term, it makes your top-line revenue look incredibly weak. It is the primary reason their overall water infrastructure revenue is down 1%, and a major factor in why that China revenue looks so catastrophic.
But you have to look at the other side of the ledger, right?
Exactly. While the revenue for the water infrastructure segment shrank, the EBITDA margin for that exact same segment expanded by 120 basis points.
Okay, that is the smoking gun. They sold less volume, but they made significantly more actual profit on the volume they did sell.
It's the ultimate proof that the strategy is working. They are prioritizing the quality of their earnings over the raw quantity of their sales. By shedding the dead weight, the overall enterprise becomes leaner, more resilient, and far more profitable.
Plus, it frees up resources.
Absolutely. Instead of wasting time on a low-margin, commoditized pump in a highly competitive European market, those engineering teams and supply chain capacity are redirected
toward high-value, highly differentiated solutions.
Right. Areas where Xylem has deep moats and massive pricing power.
Like the 20-year specialty chemical contract or the ultra-complex data center liquid cooling loops.
Exactly. It is a necessary, albeit painful, transition. Also, to your point earlier about losing market share, it's worth noting that the U.S. market is carrying the weight here. Municipal utility orders in the U.S. were up double digits, supported by massive infrastructure needs.
Okay, that context fundamentally changes how I view the China numbers. It still hurts to look at a 30% drop, sure, but if it is an exercise in addition by subtraction on the profit line, it's a sound long-term move.
I agree.
And speaking of long-term strategic moves, we need to examine how they are deploying capital to accelerate this transition. Because they aren't just shrinking the bad parts of the business, they are actively acquiring new, high-margin capabilities.
Let's talk about their mergers and acquisitions activity. In March, Xylem signed a definitive agreement to acquire a German firm that designs and manufactures highly engineered water quality instruments.
The purchase price was $219 million, right?
Correct.
They kept the specific target company's name confidential on the call, but CEO Matthew Pine noted that this acquisition expands their role as a systems intelligence partner.
Systems intelligence partner.
Yeah, and whenever I hear an industrial equipment company start using phrases like that, my first thought is that they're desperately trying to rebrand themselves as a tech company to secure a higher valuation multiple.
That happens a lot.
It does, but let's look at the actual hardware here. What does a water quality instrument company actually do?
It's about moving up the value chain, from merely moving water to profoundly understanding the chemistry of the water. This German firm specializes in advanced optical sensing and process applications across both clean water and wastewater environments.
Let's break down the mechanics of optical sensing, because it really highlights why this is such a high-margin business.
Traditional water testing often requires taking physical samples, right?
Right.
You send them to a lab, and you wait days for chemical analysis to determine if the water meets regulatory or operational standards. Optical sensing changes that paradigm entirely.
How so?
These instruments use specific wavelengths of light, often ultraviolet or infrared, to shine through the water in real time within the actual pipe or treatment tank.
Oh, wow.
Yeah. Different chemical impurities, organic compounds, or biological contaminants absorb light differently. By measuring how the light refracts or is absorbed, the sensor can instantly detect the exact chemical composition of the water.
Which is absolutely critical for the types of high-end customers we've been discussing. I mean, if you are running an AI data center cooling loop or an ultra-pure boiler feed for a chemical plant, a sudden spike in contaminants can cause millions of dollars in damage within hours.
You can't wait days for a lab report.
Exactly. You need real-time, sub-second visibility into the water chemistry so the system can automatically adjust its filtration or chemical dosing.
And by acquiring this capability, Xylem completes their value proposition. They don't just sell you the heavy iron pumps, they integrate these high-margin digital sensors into the infrastructure.
And the software.
Right. They provide the analytic software that interprets the sensor data, and they wrap it all in a long-term service contract to maintain the entire ecosystem.
It's a brilliant cross-selling opportunity. Matthew Pine explicitly noted that they expect significant revenue synergies by taking these new German instruments and pushing them through Xylem's massive existing global sales channels to their industrial and utility customers.
It accelerates their shift toward digital and service solutions, which are inherently more profitable and stickier than hardware sales.
And simultaneously, as they acquire these high-margin digital assets, they're also working to divest older, slower growth assets.
Yeah, they provided a brief update on the planned sale of their international metering business.
Right. They had previously announced they were offloading that division. But on this call, they noted a slight hiccup. Due to regulatory approval, timing, bureaucratic delays, essentially, the closure of that deal has been pushed back to the end of Q2.
It's a minor delay, but it does create some accounting noise that we will need to address when we look at their full-year guidance.
Why is that?
Because the sale is delayed, Xylem has to keep the revenue from that metering business on their books for a few extra months, which artificially bumps up their reported revenue numbers for the year.
Oh, I see. So if we step back and look at the entire story behind the Q1 numbers, the narrative is incredibly dynamic.
It really is.
You have a management team intentionally executing a painful 80-20 pruning strategy, walking away from bad business in China and Europe. You have them offsetting that pain by capturing generational structural demand in U.S. infrastructure, securing 20-year recurring service contracts, and riding an explosive wave in AI data center cooling.
And you have them actively buying high-margin analytics companies while selling off legacy hardware divisions.
It's a textbook, massive corporate restructuring. They're completely reshaping the revenue profile to be vastly more profitable, highly recurring, and fundamentally less cyclical.
But anytime you undergo a transition of this magnitude, you create near-term turbulence. The machine is being rebuilt while it is running at full speed.
Which brings us to Section 3, management guidance. What are they actually telling us to expect for the rest of 2026? What does this tug of war between booming U.S. data centers and lagging Chinese markets actually mean?
This is where the mathematical paradox we discussed at the very beginning of the show comes to a head.
Yes, the paradox.
Given the expanding margins, the record-breaking contracts, and the explosive AI demand, you would logically expect management to raise their flags and hike their forecasts across the board.
Of course.
But their actual guidance was remarkably subdued.
Let's start with the top line, the revenue forecast. For the full year 2026, they did bump up their reported revenue guidance slightly. They are now projecting between $9.2 billion and $9.3 billion in total revenue.
That's up slightly from their prior forecast of $9.1 to $9.2 billion.
But as we just established, that increase in reported revenue is largely an accounting artifact, right?
Exactly. Because the sale of the international metering business was delayed by regulatory red tape, they simply have to recognize that revenue for an extra quarter. It doesn't represent new growth. It just represents holding on to an asset a little longer than planned.
Right. To see the true health of the core business, we have to strip away those structural M&A changes and look strictly at organic revenue growth. And on an organic basis, their guidance is completely unchanged.
Unchanged. They are still expecting just 2 to 4% organic revenue growth for the full year.
For an investor watching them sign an $850 million contract and observing data center orders go vertical, a 2 to 4% growth rate seems incredibly anemic.
It feels like a massive disconnect.
It really does. How can the wins be so big, but the growth rate be so pedestrian?
It reflects two realities. First, the severe drag of the 80-20 strategy. Every time they win a massive new data center contract, they are simultaneously intentionally walking away from a low-margin municipal project in Europe. The new highly profitable growth is being masked by the deliberate shedding of bad revenue.
Okay, and the second reality?
The timing of industrial capital projects. When you find a billion-dollar water purification contract in April, that cash doesn't hit the income statement in May.
Right.
It takes years to engineer, permit, and construct these massive facilities. The top-line revenue is a lagging indicator of their actual success.
That makes a ton of sense.
Exactly. The real story and the real indicator of the underlying health of the transformation is in the profit margins. Management expects their full-year EBITDA margin to hit between 22.9% and 23.3%.
That is a massive 70 to 110 basis point expansion from the prior year. So they have high conviction that the profitability improvements we saw in Q1 are not a fluke.
No, they are structural and accelerating. They are heavily banking on their continued price realization, ongoing productivity gains at the factory level, and a projected higher volume of overall sales in the second half of the year to drive that margin expansion.
And they also specifically noted that their simplification efforts, shedding those complex bespoke projects, will help mitigate the unfavorable product mix pressures they've been fighting.
Right.
Okay, so the revenue growth is steady but slow, and the margins are expanding significantly. This all tracks logically. But here is where the math stops making sense and where retail investors really need to pay attention. Let's look at their full-year earnings per share guidance.
The EPS paradox.
Management held the full-year EPS range completely unchanged at $5.35 to $5.60.
This is the crucial discrepancy.
Corporate finance here. Share is a very literal calculation. You take the total net profit of the enterprise and you divide it by the total number of shares outstanding in the market.
It's simple division.
Exactly. If the total profit stays exactly the same, but you reduce the number of shares, the denominator, the earnings per share automatically, mathematically increases.
And as we documented earlier, Xylem just executed $581 million in share repurchases in Q1 alone.
Right. They aggressively shrank the denominator, so mathematically that massive buyback should have automatically forced them to raise their EPS guidance for the year. The math demands it.
It does.
Yet they didn't raise the forecast a single cent. Why did they swallow the mathematical benefit of a $500 million buyback without showing it to the investors?
Well, the CFO, Bill Grogan, was asked to address this directly by analysts on the call. He stated that despite the obvious mathematical benefit from the massive share repurchases, they deliberately chose to keep the EPS range unchanged.
And how did he justify it?
He framed this as reflecting a, quote, prudent approach to guidance in an uncertain macro environment.
Prudent approach?
Yes. And he went out of his way to explicitly state that this flat guidance was not a signal of a degrading underlying operational outlook, but rather an intentional layer of caution.
In the lexicon of Wall Street earnings calls, Prudent approach is the ultimate code phrase for sandbagging.
Pretty much.
It translates to, we see incredibly dark storm clouds gathering on the macroeconomic horizon, and we want to leave ourselves a massive buffer just in case the global economy goes off a cliff in the second half of the year.
It is a highly defensive posture. They took the financial engineering benefit generated by the stock buyback and essentially put it in a vault to absorb whatever unexpected macro shocks might hit their supply chain or their demand profile, rather than passing that benefit along as a flashy guidance raise that they might have to retract later.
So what exactly are the specific storm clouds they're bracing for? Because to remain entirely impartial here, we need to look strictly at the risks management actually enumerated on the call, without taking any political stance or endorsing any specific geopolitical view.
Right. From a purely operational standpoint, management explicitly listed several broader market conditions and points of volatility that their supply chain teams are actively monitoring.
What are they?
These include the ongoing geopolitical conflict in the Middle East, the potential for rapid changes in global trade tariffs, persistent underlying inflationary pressures, severe fluctuations in currency exchange rates, and ongoing interest rate volatility.
And our job is to analyze how those specific global events threaten Xylem's cost structure. Let's take the Middle East conflict, for example.
Right.
We aren't discussing the politics, we're discussing the logistics.
Exactly.
If a conflict disrupts major global shipping lanes like the Strait of Hormuz or the Red Sea, the immediate consequence is a massive spike in global fuel prices and a severe delay in maritime freight.
Which hits Xylem on two fronts. It increases the cost of every raw material component they import, and it increases the cost to physically ship their massive, heavy industrial pumps to their end customers.
Makes sense.
Similarly, any sudden changes in global trade tariffs directly and immediately alter the cost basis of raw materials like steel and copper moving across borders.
And general inflation obviously continues to drive up the cost of labor and factory operations.
Right. And this actually prompted a very pointed question from an analyst on the call regarding their supply chain vulnerability. The analyst wanted to know how insulated Xylem actually is from these sudden raw material cost spikes. Do they have long-term fixed price contracts with their suppliers to shield them from volatility?
And what did Grogan say?
Bill Grogan's response was pretty revealing. He noted that while they do have some fixed contracts in place, the protection is actually quite limited when it comes to raw commodity exposures.
Oh, wow.
Yeah. He praised their supply chain teams for being dynamic, constantly seeking alternate sourcing and running competitive bids to mitigate sudden price increases. But he conceded that their first and absolutely most powerful lever against inflation is not supply chain magic.
It's incremental pricing.
It's incremental pricing.
Which brings us back to the observation we made at the very beginning of the deep dive. Xylem does not eat the inflation. The customer eats it.
They absolutely do.
During the Q&A, when pressed on the escalation of fuel prices specifically, Grogan was remarkably casual. He mentioned that they implement immediate fuel surcharges to offset the logistics costs.
Just pass it right along.
Yeah, and he noted that if tariffs hit, Xylem has the practice and the muscle memory forged during the supply chain chaos of the COVID era to rapidly push those new costs straight through to the final invoice.
It is the ultimate real-world test of a company's market dominance. I mean, if you raise your prices to cover your fuel costs and your customers immediately abandon you for a cheaper competitor, you have zero pricing power. You are a commodity.
But Xylem's position is unique.
Extremely unique, because they provide life-critical infrastructure. A major municipality cannot simply shut down its wastewater treatment plant because the replacement pumps suddenly carry a 15% inflation surcharge.
Right. A specialty chemical plant cannot turn off its ultra-pure cooling loops because Xylem increased the maintenance fee. The demand for their core product is fiercely inelastic.
They have a captive audience whose survival depends on the product, which is why management is deeply confident they can stay ahead of the inflation curve. But even with that immense pricing power, Grogan had to admit reality. The sheer magnitude and velocity of potential supply chain disruptions right now means that you don't always get a perfect, immediate dollar-for-dollar flow-through on those price hikes. There is always a lag.
And during that lag, your margins compress.
Exactly. That potential for temporary margin compression is exactly why they are holding that EPS guidance flat. They are using the massive share buyback as an insurance policy against that exact scenario.
It is a profoundly conservative, highly disciplined approach to managing Wall Street expectations. They are deliberately under-promising so that even if the macro environment degrades, they can still over-deliver.
Before we move to the final verdict, we should probably briefly frame their specific outlook for the immediate next quarter, Q2, because it sets the stage for the rest of the year. What are the near-term expectations?
Right. Let's look at Q2. For the second quarter alone, they anticipate roughly 1% organic revenue growth.
1%. That is incredibly sluggish.
It is. However, they expect their Q2 EBITDA margins to remain very robust, hovering between 22 and 22.5%, and they are guiding for a Q2 EPS in the range of $1.31 to $1.36.
So we're looking at essentially flat organic growth in the immediate term, just 1%, as they continue to violently digest the intentional China walkaways and the ongoing 80-20 pruning in Europe. But the profitability remains rock solid.
The caveat here is that because Q2 is so slow, management noted they require a significant steep ramp in sales volume in the second half of the year to actually meet their full-year targets.
Right. They are heavily relying on normal historical seasonal trends combined with the delayed kickoff of some massive smart metering projects to drive a mid-single-digit growth rate by the fourth quarter.
It's a back half-weighted year, which always carries inherent execution risk. All right. We have meticulously unpacked the headline beat, the expanding margins, the massive strategic pivot toward long-term services and AI data center cooling, the painful but necessary intentional pruning of bad business, and a management team utilizing massive buybacks to buffer highly cautious macro-paranoid guidance.
We've covered a lot of ground.
So what does this mountain of data actually mean for you, the retail investor holding or considering XYL? Let's move into our actionable synthesis, the bottom line.
Okay, let's do it.
We're going to distill this complex narrative into concrete stances. I will build the bullish case, and you provide the bearish or cautionary counter-argument.
I'll gladly take the bear case.
Okay, the bullish case for Xylem. If you were analyzing the stock, you are looking at an incredibly defensive, fundamentally essential fortress with visibility that stretches into decades, not just quarters. The foundational argument begins with their core market. Domestic U.S. infrastructure.
A huge market.
On the call, the CEO explicitly cited the U.S. Army Corps of Engineers, noting that the current state of U.S. water infrastructure, our drinking water systems, our municipal wastewater facilities, our stormwater management, currently holds an official grade ranging from a C- to a D+.
Those are near-failing grades for systems that literally keep society functioning.
Exactly. We are talking about century-old pipes, chronic water main breaks, massive losses of non-revenue water due to leaks, and treatment facilities that cannot handle modern storm surges. It is a systemic, catastrophic liability.
And fixing it won't be cheap.
No. To fix it, or frankly, just to maintain those terrible near-failing grades and prevent total collapse, the U.S. government and municipalities need to invest an estimated $1.5 trillion over the next decade alone.
$1.5 trillion.
That is not speculative tech growth. That is guaranteed structural, non-negotiable demand. Xylem is the apex predator, positioned to capture that spending.
The macro tailwind of infrastructure decay is undeniable.
And then you layer on top of that their brilliant strategic pivots. They aren't just selling dumb pipes anymore. They just locked in a 20-year, $850 million service contract that guarantees highly profitable recurring revenue until the year 2048.
Yeah, that's wild.
They are acquiring high-margin optical sensing analytics to become a water tech software play. And almost by accident, they have become a backdoor, pick-and-shovel investment in the artificial intelligence boom, with data center liquid cooling orders going vertical because the physics of AI demand it.
Right.
You have a company with recession-proof, inelastic demand streams, immense pricing power, and a management team buying back $500 million of stock. This is a foundational, buy-and-hold-forever portfolio anchor.
Okay. That is a highly compelling multi-decade narrative.
Right.
But as an equity investor, you do not get to magically teleport to 2048.
Fair point.
You have to survive the volatility of the short term to reap the rewards of the long term. And here is the bearish, or at least the highly cautionary case. The near-term organic growth profile of this company is undeniably, frustratingly sluggish. Guiding for merely 1% organic growth in Q2 is not going to attract any momentum or growth investors.
It requires immense patience.
It requires weathering significant execution risk. Furthermore, management's deliberate decision to hold the EPS guidance flat, despite the massive mathematical tailwind of the share repurchases, is a flashing yellow light on the dashboard.
You think they're worried?
It proves that the C-suite sees very real, highly tangible potential for severe global macroeconomic disruptions to eat into their profit margins over the next 6 to 9 months.
The storm clouds of supply chains, tariffs, and shipping lane conflicts.
Correct. While they boast about pricing power and fuel surcharges, the CFO openly admitted that massive, sudden macro shocks will compress their margins before the price hikes can catch up. Furthermore, the internal bleeding from their strategic transition is not over. They are still actively wading through the margin-crushing pain of their 80/20 pruning strategy and trying to stabilize a 30% revenue crater in the Chinese market.
It's a lot to balance.
Because the first half of the year is so slow, they are entirely dependent on a massive back half-weighted acceleration in volume to hit their full-year targets. If those smart metering projects get delayed by bureaucracy again, or if municipal utility budgets suddenly freeze due to persistently high interest rates, Xylem could easily miss those fourth quarter targets.
So you're saying?
The immediate upside for the stock over the next 2 to 3 quarters is severely capped by these macro headwinds and the friction of their own internal restructuring.
Okay, so we have an unstoppable, multi-decade macro force meeting a very sluggish, high-friction, near-term reality. When we synthesize these two opposing views, what is the actionable verdict for the retail investor listening to this right now?
The verdict is clear. Xylem is absolutely not a quick flip growth stock for the next quarter. If you're looking for rapid, double-digit top-line momentum or a short-term trade ahead of the next earnings print, you are looking in the wrong place.
Right.
However, it represents an elite, blue-chip, long-term infrastructure play.
The structural shift from hardware to recurring services is the defining thesis.
Yes, they are successfully executing the hardest maneuver in the industrial sector. Moving away from low-margin, highly commoditized cyclical hardware sales and aggressively shifting toward high-margin recurring service contracts and digital analytics.
Right.
That transformation makes it a profoundly solid foundational piece for a diversified portfolio. But buyers need to be mentally prepared for a slow, potentially frustrating sideways grind through the remainder of 2026.
You gotta have a strong stomach.
You have to be willing to hold the stock and absorb the turbulence while management digests the China market share losses, finalizes the European divestitures, and waits for the actual cash flow from those 20-year service contracts and data center builds to materialize on the income statement.
It is the kind of equity you buy. Lock in the vault, collect the growing dividend, and let the slow, inevitable decay of global infrastructure work in your favor over a decade.
Precisely. The structural investment thesis is incredibly sound, but the entry requires patience and a high tolerance for near-term macroeconomic noise.
Well, that thoroughly unpacks our deep dive into Xylem's Q1 2026 earnings and the complex cross-currents driving their business. But before we sign off, I want to leave you with one final, broader philosophical thought inspired by this earnings call.
Let's hear the closing thought.
We spent a lot of time discussing that U.S. Army Corps of Engineers rating, a C- to D+ for life-critical water infrastructure. And we talked about the $1.5 trillion of capital required just to reach a baseline acceptable level of functionality over the next decade.
Yeah, massive numbers.
It makes you step back and wonder about the nature of the market itself. Are companies like Xylem actually competing in a traditional free market? Or because the need for water is so absolute, so biological, and the funding is almost entirely dependent on municipal utility budgets and federal grants?
Is something else?
Exactly. Are they effectively functioning as a privatized shadow branch of government infrastructure? They are essentially relying on the government to inevitably unlock the massive funds required to keep society from quite literally drying up or drowning in its own waste.
Is a profound structural question. When the product being sold is fundamental human survival, the normal economic rules of supply and demand begin to warp and break down.
Definitely.
It is definitely an angle to mull over as you analyze your own portfolio strategy. Take a look at your holdings and see how much exposure you actually have to these invisible utilities. The silent, highly engineered giants making sure the municipal water flows and the AI data centers don't suffer a thermal meltdown.
Thank you for joining us on this deep dive. We will catch you on the next one.